Hello, it is my great pleasure to virtually welcome John Wisliams to participate at the Bank of Israel and the CEPR's Inflation Conference. I think John needs no introduction, but I will still go ahead and do that. So John is the president and CEO of the Federal Reserve Bank of New York since 2018. In that capacity, he serves as the vice chairman and a permanent member of the Federal Open Market Committee, the FOMC. Before coming to the New York Fed, he was the president and CEO of the Federal Reserve Bank of San Francisco. Prior to that, he was the executive vice president and director of research for the San Francisco Fed, which he joined in 2002. He also has served as a senior economist at the White House Council of Economic Advisors and as a lecturer at Stanford University Graduate School of Business. Mr. Wisliams has produced seminal research on such critical monetary policy issues as the zero lower bound and the neutral rate of interest. He has a PhD in economics from Stanford University, a Master of Science from the LSE, and an AB from the University of California at Berkeley. Pretty good names there. It's really an honor for us to have John to speak about the theory of average inflation targeting, and will refer to how inflation targeting should evolve to be successful in the context of a global economy characterized by a very low neutral interest rate. After John's talk, I'll continue with a few questions, pretty much right after that. And if time will permit, those of you who want to ask some questions, please do so on the public chat, and I will monitor that. So here we go. Thank you again, John, in advance, and we're all looking forward to your talk.
Well, great. Good afternoon, and thank you. I hope you can hear me all right. And thank you, Governor Yron, for that kind introduction. It's truly a pleasure to speak at this conference. So much has happened in the world and in monetary policy in the year and a half since the onset of the COVID-19 pandemic. However, I will not use my time today to discuss the specific challenges posed by the pandemic. Rather, I'll return to a topic that predates COVID and will be critically important for central banks in the post-pandemic era. Specifically, how inflation targeting should evolve to be successful in the context of a global economy characterized by very low neutral interest rates. I'll start by describing the challenges that the combination of very low real neutral interest rates and the lower bound and nominal interest rates pose for standard versions of inflation targeting. I'll then summarize the theoretical underpinnings of what's commonly referred to now as average inflation targeting, or AIT for short. I'll focus on the key characteristics of various versions of AIT and how they can help mitigate the negative effects of the lower bound on interest rates on macroeconomic outcomes. I should be clear from the start that the goal of my presentation is to engage in the broad academic and central bank discussion on monetary policy strategies. And this is not and should not be interpreted as a description of the Federal Reserve's new policy framework or the practical application of AIT to real world situations. But also be remiss not to mention that most of what I discuss today is based on research conducted with my esteemed colleague Thomas Mertens at the Federal Reserve Bank of San Francisco. And with that preamble, it's time to give the standard Fed disclaimer that the views I express are my own and do not necessarily reflect those of the Federal Open Market Committee or anyone else in the Federal Reserve System. So the adoption of inflation targeting by many central banks succeeded in bringing the high and variable inflation rates of the 70s and 80s under control and in anchoring inflation expectations. The success in attaining price stability and well-anchored inflation expectations was a monumental achievement in central banking, and one that's critically important to sustain. However, the significant decline in the neutral rate of interest observed across the globe poses a fundamental challenge to the ability of inflation targeting central banks to achieve desired macroeconomic objectives and anchor inflation expectations at the targeted level. So figure 1, which is shown there, shows the GDP weighted average of the Holston, Laubach, and Williams estimates of the longer run real neutral interest rates, or R star, for Canada, the Euro area, the United Kingdom, and the United States. As seen in the figure, and consistent with a variety of other analyses, there's been a dramatic decline in R-star over the past quarter century. Several global developments have driven this decline, including demographic shifts, lower productivity growth, and increased demand for safe assets. And these trends do not appear likely to reverse anytime soon. Due in part to the decline in neutral interest rates, central banks have been increasingly constrained by the lower bound on nominal interest rates, including after the outbreak of COVID-19. The lower bound in interest rates has hindered the ability to use lower short-term interest rates to offset negative shocks, which has contributed to inflation rates averaging below targeted levels in many countries. To highlight the connections between R-star, the lower bound in interest rates, and below target inflation, Thomas Mertens and I analyzed a simple new Keynesian model where the lower bound occasionally constrains the ability of the central bank to offset negative shocks to the economy. Our analysis shows that due to the presence of the lower bound, standard inflation targeting under discretion leads to inflation that is on average below the target level, and this below target average inflation in turn causes expected inflation to likewise be below the target level, to the detriment of the achievement of macroeconomic goals. Now, to keep the analysis tractable, the inflation targeting central bank is assumed to follow optimal policy under discretion, using the short-term interest rate as its sole policy instrument. That is, we ignore other policy tools like asset purchases that can provide additional monetary stimulus following negative shocks and thereby reduce the severity of the effects of the lower bound on the economy. Absent the lower bound in interest rates, optimal policy fully offsets demand shocks and partially offsets supply shocks. This results in inflation, and inflation expectations are at the target level on average. Now, this happy set of circumstances is upset by the lower bound on interest rates, occasionally constraining the ability of policy to respond to negative shocks. Owing to the inherent asymmetry of the lower bound, monetary policy responds more strongly on average to positive shocks than to negative shocks. From there, it's a simple matter of arithmetic. Shortfalls of inflation from targeted levels will on average be larger than the overshoots. And as a consequence, the average inflation rate will be below targeted levels. With inflation averaging below the target level, inflation expectations will also be anchored below the target. And this reduction in inflation expectations in turn worsens the effects of the lower bound on the economy. Now, these results hold whether the central bank targets only the inflation rate or has dual objectives related to inflation and output. Now, in our current research, Thomas Mertens and I have extended this analysis to a two-country model and examine the spillovers from the lower bound across borders. The basic conclusion from this work is that the presence of the lower bound adds to the ways by which economic conditions spill over across the economies, and that can worsen the negative effects of the lower bound in each country. The implication is that the greater the effects of the lower bound are on the economy of a trading partner, the greater the challenge for the domestic central bank in achieving its goals. Now, a number of modifications to standard inflation targeting have been proposed to address the effects of the lower bound in interest rates. Now, each proposal has unique features and implications, but many can be broadly described under a big tent of average inflation targeting, in that they aim to overshoot the long-run inflation target at times so the inflation rate is close or equal to the targeted level on average. So one relatively modest modification to standard inflation targeting is something that we call static average inflation targeting, or static AIT. This policy is identical to standard inflation targeting, except that it overcomes the downward bias to average inflation caused by the lower bound by overshooting the inflation target in periods when the lower bound is not constraining policy. This is mathematically equivalent to reducing the intercept in the monetary policy rule by an appropriate amount, which depends on the probability of being the lower bound and other parameters. So figure 2 shows the model responses of inflation, the output gap, and interest rates to a severe negative demand shock that lasts for just one period. Now, the period is labeled period 0 in the figure. And we show this for both standard inflation targeting and for the static AIT. For these simulations, we assume the following: the long-run target level of the inflation rate is 0, lower bound is -0.5%, and the real neutral rate is 1%. Now, under standard inflation targeting, inflation is on average below the target, as seen clearly in the levels of inflation in the periods before and after the shock. In response to the negative demand shock, the lower bound constrains the inflation targeting policy, and the output gap and inflation fall further below targeted levels. We should still be on figure 2. before returning to their corresponding mean levels in the following period. Can we go back to figure 2? Thank you. In contrast, the static average inflation targeting policy delivers inflation and inflation expectations that are on average equal to the target level. And this higher level of expected inflation boosts inflation in the period of the shock, and importantly, creates more room for policy to lower the real interest rate below the neutral rate. As a result, the shortfalls in the output gap in inflation are attenuated relative to standard inflation targeting. Note that the effectiveness of static AIT is based solely on anchoring inflation expectations of the target, and this is achieved by delivering longer-term mean inflation equal to the target. To better see how this static average inflation targeting policy works, it's actually useful to look at the responses to a positive demand shock. Now that's shown in figure 3, so if we could turn to figure 3. Under both standard inflation targeting and under the static average inflation targeting, the demand shock is fully offset by higher real interest rate. That's the optimal policy under discretion. However, that does not imply that the output gap equals 0. Under standard inflation targeting, the fact that inflation expectations are below target causes policy to be slightly accommodative, leading to a positive output gap, and inflation that's closer to, but still below the target. Under static average inflation targeting, policy intentionally aims for a positive output gap and inflation rate. This is exactly the overshooting feature of static AIT that provides the positive offset to outcomes when policy is constrained, thereby bringing mean inflation and the output gap equal to the respective long-run target levels. Note that these outcomes under both inflation targeting and static AIT are invariant to the size of the demand shock as long as policy is unconstrained by the lower bound. Now, a number of alternatives to AIT have been proposed that include dependence on the past state of the economy, either in terms of interest rates or inflation. And we refer to these as dynamic average inflation targeting. Now, these include policies that target a multi-year average of inflation, or target the price level, or account for past constraints. Can you still hear me? I got a signal that I was muted.
I hear you.
Okay, thank you. These include policies that account for multi-year average of inflation, target the price level, or account for past constraints in the setting of policy. Now, they differ in their details, but these proposed policies fundamentally work through the same mechanism of delivering interest rates that are lower for longer following a negative shock. Under these policies, expectations of easier monetary policy in the future provide additional policy stimulus at the time that the lower bound constraint is binding, thus mitigating some of the negative effects of the lower bound constraint on the economy. Now, to keep things simple, I'm not going to go through all the variations, and I'll focus on just one version of dynamic AIT, and that's one that Dave Reifschneider and I proposed in a paper about 20 years ago. Now, this policy rule is otherwise identical to inflation targeting, but it makes up for past missed monetary stimulus owing to the lower bound constraint. Specifically, the current setting of the interest rate is adjusted based on a term that keeps track of the cumulative past effects of the lower bound on the setting of interest rates, net of past makeup adjustments to policy. This behavior of this Reifschneider-Williams or RW policy rule following episodes of policy being constrained by the lower bound is qualitatively very similar to policies that target a multi-period average rate of inflation or end price level target. Now, the RW rule delivers inflation and inflation expectations that are on average equal to the targeted level, as the lower for longer setting of interest rates following periods when the lower bound constraints policy mitigates the effects of negative shocks in the economy. And figure 4 compares the responses to a negative demand shock under the RW rule to that under standard inflation targeting. Under the RW policy, the real interest rate is below the neutral rate in the period following the shock. And this reflects the effect of the makeup for missed monetary stimulus during the period of the shock when the short-term interest rate was constrained by the lower bound. As a result, the output gap and inflation rate are actually above target levels in the period following the shock, and then return close to the target levels in the subsequent period. Now, this is a key feature of dynamic AIT policies. It's the expectation of future stimulus that supports the economy during the time when policy is constrained by the lower bound. Of course, for this to work in practice, expectations of future policy actions and their economic consequences need to be aligned with the policy strategy. Now, so far I've aimed to provide some high-level theoretical underpinnings of AIT policies and their potential advantages in an environment where the lower bound occasionally constrains policy. Commentators have highlighted a number of potential shortcomings of AIT relative to standard inflation targeting, so I'll briefly address two in the time remaining. Now, the first claim is that this overshooting of the inflation targeting implied by AIT risks undermining the anchoring of inflation expectations to the upside. Now, I would argue that if anything, AIT strengthens the expectations anchor compared to standard inflation targeting. The main point of AIT, of course, is to offset the downward bias to inflation expectations exerted by the lower bound under inflation targeting. That said, if the lower bound were to prove to be a less frequent constraint on policy in the future, then the AIT policies that I've described here today would act very much like standard inflation targeting. Now, the second claim is that AIT implies sharp reversals of interest rates as monetary policy exits a lower for longer episode and may find itself behind the curve. However, as seen in the responses of nominal and real interest rates to the shocks that are shown in the figures 2 through 4, there's no predictable pattern of sharp reversals or large overshooting of policy rates relative to neutral, either for static or dynamic AIT policies. Now, it's true that nominal and real interest rates have more room to fall under AIT policies in response to negative shocks compared to inflation targeting, and therefore the rebound to the neutral rate is correspondingly larger. But that larger rebound is a feature of the success of the policy. In addition, the RW policy is still below neutral when the output gap and inflation are above target. So the reversal of rates is actually gradual, not rapid in that case. Of course, the policy setting depends on the sequence of shocks in the particular model used for the analysis. And although the results I've reported here are derived from a very simple model, the main findings about the benefits of AIT are also obtained in much more complex models with extensive nominal rigidities, as shown in the work that I did with Dave Reifschneider. So to close, in this presentation, I aim to provide a high-level theoretical overview of the mechanisms by which versions of average inflation targeting can deliver improved macroeconomic outcomes in the presence of a lower bound on interest rates. Importantly, the versions of AIT that I've described represent an evolution of inflation targeting rather than a revolution. Indeed, the fundamental aims are the same: to ensure well-anchored inflation and inflation expectations at the target level. Thank you. I look forward to your questions.
You are muted.
I'm sorry, I couldn't quite hear you. My sound went out for a moment.
It's not you, but it's Governor Yron is muted.
Can you hear me now? All right.
Yes.
Well, it's part of technology. So first of all, again, thank you so much for this wonderful talk. And I think it's right, you know, right in the middle, as we say, you hit it between just academic enough and just takes us into the realm of policy and really underlying the logic of the compensation that's underneath AIT and DAIT and SAIT. I'll start with a few questions. First of all, the ECB has just declared its new monetary strategy, and they state that price stability is best maintained by aiming for 2% inflation over a medium term and emphasizing its commitment to this target as symmetric. And one thing is, how should we think about that? Is that closer to the AIT or the dynamic AIT or SIT? And moreover, when you think of the symmetry and the underlying logic here all stems from essentially asymmetry that is stemmed at the ZLB. And you yourself mentioned that as if ZLB doesn't recur too much, you essentially revert back to standard inflation targeting. So how would you think, if you were for a while quite above, which may be a situation that we're getting close to at some point, quite above in terms of inflation and or interest rates, and what would that do?
I can't, your mic seemed to go out again at the end. By the way, while we're waiting, can we take the slide down? I don't think we need the slides up anymore, if that's possible. If that's not possible.
Okay, I apologize. I don't know where it stopped, but basically my question was, I don't know. Yeah, so I'm saying, A, how would you describe, or your interpretation of this symmetry, and whether the kind of what the ECB has declared, is it closer in your thinking to the dynamic or version of the AIT? And two, exactly, can you comment a little bit more about the symmetric part, and what do you do if you are above, you know, interest rates? You've already gone, interest rates are for a while above, and inflation is quite above the target rate. What do you do there? Do you keep rates for quite a while, just like low for longer? Do you keep them high for longer?
Well, those are big questions. I'll try my best to answer them all. First of all, you know, obviously I'm watching carefully what the European Central Bank did, their announcement last week. And I think it's best to let them describe exactly how they're going to implement their policy framework. I will note a couple things that I think are important, because it's common to their explanation of the reasons for their framework, and also the reasons that we at the Federal Reserve provided in terms of our framework review. And they really are, and I want to underline this, global factors affecting the economic environment that we're carrying out our policy. And one is globally low neutral interest rates, which has been noted by many people over the past many years. The second is a tendency for inflation to run below target in many, not all, but many jurisdictions before COVID. And you know, other global factors that may be affecting how the economy is changing, maybe the channels by which monetary policy affect the economy and inflation. So I think that what we're seeing is, you know, when I look at the framework review that they've done, we've done, and you know, in other conversations, that clearly, you know, people are taking into account some you know, longer term trend changes in the economic environment, which I think are, you know, very important. In terms of, you know, their policy, in terms of the symmetry, and I think that, you know, the key, the word I kind of focus on in my presentation, and I think that comes up a lot in these discussions, is really the importance of anchoring inflation. And anchoring inflation expectations at the target level, and making sure that the inflation outcomes that come out of that are both above and below. And so I think that message, which came out loud and clear from our review and our decisions, and it came out in the ECB's, I think are really important. This is about anchoring inflation expectations at the desired target level. Now, in terms of this symmetry and you know, positive shocks that move inflation above the target, as I pointed out in my presentation, you know, the policies that at least I discussed in today, and in a number of the policies that Thomas Burns and I have studied, they have the feature that, you know, when you're not at the lower bound, or you're not you know, leaving a period of being at the lower bound, the policies are basically behave very much like standard inflation targeting. The response to shocks is basically the same in terms of whether it's supply or demand shocks. And so what's nice about, I think, the features of some of the AIT style policies that I talked about is that they do carry with them all the benefits of inflation targeting, because inflation targeting has been hugely successful. It carries with them those benefits, and also making sure that inflation, importantly, making sure inflation isn't too high for a long period of time. but they really are tuned, if you will, to dealing with inflation that could fall below target because of being at the lower bound. Now, it's true that some of the proposals, like price level targeting or average, targeting an average inflation rate over many years, those actually are kind of a little bit further away from standard inflation target, a bit more of a modification. But the ones I talked about here are very close to standard inflation target. So the answer to your question is, like under standard inflation target, if inflation is persistently too high, then the central bank would adjust policy in order to get inflation back to the target, and most importantly, deliver that average inflation rate at the target and anchor inflation expectations at the target.
All right. Thanks, John. I want to ask one additional question about the model. The model abstracts right now from any QE instrument, and the question is, how do you add that to the model? Would the analysis or the inclusion of QE as an instrument would change any of the conclusion in terms of how you think of the averaging that's needed to be the adjustments, maybe even the sequencing of how the Fed uses those two instruments? And while you're at it, maybe you can tell us whether you think QE in general is a conventional tool, or it's more an unconventional tool that is reserved for more unconventional times.
Yeah. So on your first part of your question, we're trying to do this we're doing all of our analysis analytically, and as you well know, deriving analytical results in models requires simplifying assumptions. And in this case, not considering QE or policies like that was one of the simplifying assumptions that we made. So here's how I think about it. Now I am, using kind of my, speculating a bit. We've not done the math to work all of this out, but based on how I think about this, I think in our analysis, having the ability to do asset purchases, effectively during periods when you're at the lower bound, especially, effectively gives you additional ability to add monetary accommodation. So you can think of this as maybe either as like having a lower bound kind of in a way, or a lower, R star. Having the ability to stimulate aggregate demand more than is shown by our paper. So what does that mean? I think unless you think QE can perfectly offset the limitations of the lower bound, if you think it helps mitigate, which I do, it does help mitigate the effects of the lower bound, but not completely eliminate the effects of lower bound, then what it means from our model point of view is it reduces the magnitude of some of the effects that we're talking about, but the effects would still be there. And I think that the issue of sequencing is interesting, and this is why it's hard to do in a simple model like this, is that QE, primarily I think works through the cumulative purchases. It's the stock of assets that the central bank is taking out of the market. And in doing so, that's naturally a kind of a dynamic set of decisions that take place over time, kind of harder to model in this setup. And so I think from when I think about the sequencing issue, I think that it's moving interest rates is relatively straightforward. We have decades and decades of experience of moving short-term interest rates. It is more challenging and also more uncertain, changing the parameters of asset purchases, whether when you're starting it during the period of purchases or when you end it. And I think that one of the things we all recognize from past experiences that is something that does not move on a dime in the same way. Again, because it's the stock of assets that are out there that matters. That does not move on a dime. So I view the sequencing decisions that we've done in the past, have made sense. That you kind of move the asset purchase lever earlier than you move the short-term interest rate, because of kind of the different dynamics around that.
All right, thank you. As somebody who also have written many models, I fully appreciate simplifying them and then thinking outside of them. And then when you add transitional dynamics, it becomes a whole host of issues. So I completely respect that, but I think it is an important current issue, how to think about those
Well, I'm sure we've both written in our papers at the end, it's a topic for future research, right?
Yes. I want to go a little bit into communication. You guys have done what seems to be a very wide spectrum of stakeholders in terms of your assessment. And my question is, do you have a sense that the communication to the public of the new AIT policy framework is well understood? Does the public understand this new concept and its consequences for monetary policy? And is there a chance that actually this new framework, which involves averaging and maybe timing, it's not clear averaging over how much time, what exactly do we mean by that, actually increases uncertainty concerning future policy and inflation?
Well, so we did, I agree with the point you made at the beginning. We've done a lot of outreach to the, I would say, business and community leaders across the country on the Fed Listens and other efforts we took, and also with the academic community with a really good conference as well. And a lot of research has gone into a lot of the thinking around the Fed's framework review. In terms of communications, I do think we have different, you have different audiences that you're communicating with. There's obviously the market participants, there's the academic world, there's and the broader public, and those are, I think, what's important for the different groups is really important for us to keep in mind too. So from my perspective, when I think about what is it we're really communicating to the public in our framework, I think several things, but one is that we really want inflation to be 2% on average. So if you think about a person's decision, that we all make these decisions about, you're going to borrow to buy a house or a car, you're going to save for your retirement or your kid's education. These are things that tend to be multi-year, longer-term investments. Or decisions. So you really want to have a confidence that inflation is going to be, roughly 2% over that longer horizon. You don't have to worry about, is it going to be, much higher or much lower. And I think that was a success, huge success of inflation targeting to do that. I think the zero lower bound, unfortunately, caused this downward bias to inflation, where inflation started drifting lower and inflation expectations were at risk of drifting lower. So I actually, again, would reiterate that I think, although you might say, well, in the short term, inflation moves up and down under any kind of framework, it's really about anchoring this view of what inflation is going to be over the longer term. The second thing I mentioned, and you already said this, is we did not tie ourselves to any equation or formula or anything like this. There's no sense of a mathematical representation of our framework. Our framework is really, I'm going to use the word anchored a lot here, so I should probably get out thesaurus while we're talking, but is really tied to anchoring inflation at 2%, delivering this average over time. And I think of monetary policy as working over the medium term. So I'm thinking that over time is not months or weeks and months; it's over many years, and really delivering that consistently over time. So I think that from the general public point of view, I think that's an important message, that kind of reducing some of that medium longer term uncertainty about where inflation is going to be. I think the other big message is that we learned from the previous episode that our economy can run very strong, strong employment, low unemployment, without creating without creating inflationary pressures. And so, we really did emphasize in the U.S. context that we have a dual mandate and we take the maximum employment very seriously. I think that's a message that people do hear and understand, that we want to see a strong economy, one with 2% average inflation. In terms of the market, participants, we do the surveys of market participants every FOMC round, and I have been struck that people may have different views of when we're going to make policy decisions, but overall there seems to be a pretty clear understanding of how the framework, and importantly our forward guidance, has what it implies for future policy decisions. So it seems like the different audiences, I can't, it's hard to know what the general public thinks about our monetary policy strategy right now, but I think those who follow us closely seem to understood some of the key changes. Now, I will just say one last word on this. If you want to anchor inflation expectations at 2% or whatever your target is, deliver 2% on average. And I think that will take care of itself. So that's, I think that may take time to get that kind of time series experience, but I think the evidence is that the general public's inflation expectations are based on the inflation they've seen in their lives, and so we just got to deliver on that.
All right, thanks. This was really thoughtful and useful for all of us to hear. I often, when I have media sessions here, some of them tell me I have one question and then they entangled in 3 questions, so I'll do the same. Basically, there seemed to be a current spike in inflation in the U.S. And you know, the Fed has looked at various components of the prices, and the question in question is, can you give us sort of your view? Is there a real structural change? Is there a change in the Phillips curve in terms of how it's flattened? Some structural changes in the relationship in activity versus this inflation? This is the question in question. The question I'm aiming to is linked to communication. With this spike in inflation, at least in Israel, we see a lot of political debate about, it's very difficult to explain, why would you even want to have an inflation, okay? People talk about cost of living and inflation. These are not the same thing. And how do you convince the public that the central bank should see through temporary price hikes and strive towards inflation even higher than 2%, when exiting a recession, vis-a-vis the AIT, when at least in many places, publics and politicians are extremely unpleased with, prices, every price rise that they see. So this is the 2 questions in question.
I think I could add up a few extra number of questions you're asking once. So first of all, the first part I think is really important question or important issue, and that is that COVID has, it's just an enormous shock. It's a combination of supply, demand, and something else that's just not kind of a standard business cycle experience, and we shouldn't think about it that way. So getting to your question about the Phillips curve or things like that, I feel like right now, the last year and a half, if anything, has taught us that with these huge shocks to both the supply and demand side of the economy, it's really hard in the short run, in the very near term, to decipher kind of what is an underlying or persistent factor versus a temporary factor. And so we have to be humble in our ability to draw those conclusions. Similarly, that would be true of, are there fundamental shifts to productivity or R-star or other things? I think we just have to watch the data and learn as the economy continues to progress in a positive way. So I I'm not drawing any strong conclusions about any significant structural changes, because I think there's just too much happening to have that kind of identification, if I can talk like an economist, to understand really what's driving things and how to interpret it. In terms of the inflation spikes and reading through those or looking through those, I think that we have to be clear that we're doing that consistently. That's true of a decline in prices or a decline in inflation as well as a positive one. So this can't be opportunistic of saying, well, some ones I look through, some temporary shocks I look through and others I don't. And I try to be very consistent in that. There were some declines in prices right at the onset of COVID, which were clearly transitory, and they have reversed, and we want to understand that. So I think that for me, the most important thing is to study the data and analyze it very carefully. We have all this amazing micro data, high frequency data on prices and economic activity. Really try to understand as much as we can about what the drivers of things, developments are, infer as best we can, and be humble and recognize that there's a lot of uncertainty about things. Now, in terms of the unpopularity of positive price increases, I totally agree. I mean, anyone who's been buying anything where the price is going up, and that's everybody, experiences that. So I don't in any way say that they aren't happening or diminish their importance. They're real. They are affecting affecting people's purchasing power. I think that from a monetary policy point of view, really want to be focused on this medium-term outlook. And so obviously pay careful attention to seeing if there are signs that inflation is picking up in a medium-term way or a more persistent way, but also making sure that, you know, as we think about things, that anything that's transitory and temporary, be able to look through that. Again, we also have in the U.S. a dual mandate, so we have to make sure that we're as we look through these different shocks and developments, is making sure that we're focused on both sides of that, which is the maximum employment and the price stability or 2% inflation goal, and getting the right balance there.
Thank you. You mentioned the dual mandate, and that was almost going to be my third question. And with that, and the AIT being in place, do you actually think that having the AIT in place has changed? Maybe this is sort of a if statement, if question, and I don't know if one can answer it very, very easily, but would the Fed have looked at things realistically different had the AIT not been in place in during the COVID, in terms of its actions? Is there it's maybe it's a framework of thinking, but the confidence interval of interpreting this is wide enough that it's in practical sense, the actions are very similar.
Well, I mean, it's a great question, but here's my view. I'm just, I guess, speak how I think best. You know, we've thought long and hard about the experience of a decade following the financial crisis. And I feel that, a lot of the lessons from that, with the unemployment getting down to 3.5% in our case, and seeing inflation low in the US, even with a very strong economy, the very low R-star, the change in inflation dynamics, and what we've seen around the world, convinced, I think, of compelling evidence for the changes that we made in our framework. So, so the question you're really asking is, do you need to change your framework, or could you just change your policy? So from my perspective, I think there's huge advantages to actually having the framework developed, spend all that time working on it, and getting to a shared understanding of the framework, so the policy actions that we take are consistent and aligned with the strategy that we've laid out. I think that helps both within the policy committee, that people have said, we've really worked through this and understood what does success look like. And then now the question is, how do you execute on that? How do you communicate that? I think it also helps in the communication to the public, all aspects of the public that you mentioned, that we have this framework statement, which we somehow did manage to fit on one page, which I'm very proud of. And it says, this is how we're thinking about it. This is how we're combining the dual mandate objectives. Here's how we're putting all this together. And then you look at our policy statements, the FOMC issues, they're tied right to the framework. So you have the overarching strategy, what it means in terms of monetary policy goals and strategy, and then you say, and here's how we're executing against that in the extraordinarily unusual circumstances we find ourselves in this COVID environment. So I feel that from a communications point of view, it's very helpful. I also think from aligning inflation expectations, we have actually seen, I think, some benefits with the framework and the policy execution that, we've seen some shifts in at least inflation expectations and other indicators that suggest that maybe this did help move expectations closer to what we were trying to achieve. So I guess you could do it without the framework. I think it would be, not be as effective, because I think the framework and the policy working hand in hand is really maximize the effectiveness of policy.
All right, I have a few more minutes, so I'm trying to squeeze as much as I can. I think I can imagine your answer, but nonetheless, just for kind of to be clear about it, there are some say, don't get complicated, just raise the target to 3% or so. Get farther away from ZLB. And I guess the natural asymmetry that you talked about, and on the one hand, and maybe low R star as a phenomena happening in the background, are things that have pushed you perhaps to the AIT as opposed to that kind of a solution. But I'd be curious to hear your mind on that.
Well, clearly, there are a lot of discussion around this in the academic and community over many years. I think that the issue of raising the inflation target permanently by a significant amount would reduce the effects of the lower bound, as you just said. However, it would at the cost of having inflation higher all the time. And there are costs to higher inflation. I think that 2% is a kind of a good compromise in providing that inflation kind of cushion, if you will, to deal with downward negative shocks. But is not so high that it interferes with the effect, interferes with the economy achieving its potential and not getting in the way of the efficiency of our economy. So I think that 2% inflation is a very good place to be, and it's proven its value. So, and then the issue is, well, you have the lower R star, you have the lower bound. We've seen that. Using a policy like a version of AIT, and I mentioned there's lots of different variations on that, and some stronger, some somewhere in between. You can reduce and mitigate the effects of the lower bound, especially on this average level of inflation expectations, without having to raise the inflation target. So I think that these policies and these approaches can offset much of the effects of the lower bound without having the cost of higher inflation all the time. So that's how I view it.
All right, I'm going to ask one last question, which I think I cannot escape given the time. Given the low for longer, given some of the environment that we are seeing in other markets, how do you see, as the averaging perhaps has to go for longer, what are the risks that you see in prolonged periods of low interest rates, specifically risks for low for longer, on the potential towards financial stability, and how do you sort of mix that in your thinking as you're going about policy in terms of all these things?
So I assume you set aside an hour for that last question, right?
Yeah.
The hardest, biggest question that we all deal with, as you all know. So I guess I'm going to give a couple quick responses. Obviously, don't have time to go into this in depth. The first is, and I know this audience, I think, understands that, but I think it's really important to remember that much of the low interest rates that we're seeing over the past 10 years, just even in times when the economies are doing well, the reason they're low is because of low neutral rates. So it's not necessarily, it's not just about low interest rates relative to neutral, which obviously is happening now because of the COVID situation, but we have low neutral rates. So I think that sometimes people conflate that when they say, well, the lower for longer, when in fact a lot of the low is actually the low neutral rate. So that's the first comment. The second is, if you look at these policies that any of the AIT policies that I talked about, they actually they're designed to raise the average inflation rate back to the target level or close to the target level. So they're actually delivering somewhat higher average nominal interest rates. It's really about the dynamic of it. The lower for longer is for following a period of being in the lower bound or a severe downturn, but then on average, the nominal interest rate and the inflation rate are higher, but back to the target level. And so I think that's another point to make, is that, the point of having a lower for longer, at least in those policies, if, according to the analysis that's been done, is really to deliver that 2% or whatever inflation target you have, and nominal interest rates will get back to that higher level. So maybe mitigating some of the financial stability concerns that people have about low rates. Because if you don't deal with this, if you have inflation expectations that drift lower and lower, then nominal interest rates will, in line with that, drift lower and lower. And then I think the lower becomes, kind of ingrained into the system. And then finally, on the financial stability, I do feel that strongly that monetary policy has a lot to try to accomplish in terms of achieving inflation goals, anchoring inflation expectations of target. We have also the maximum employment mandate, and it really is important that the various regulatory, supervisory, micro and macro prudential authorities and policies really designed to strengthen the financial system so that monetary policy can really be focused on the economy. actually, we've seen the benefit of that. After the financial crisis, the reforms in the United States have led to a much stronger banking system, which withstood the COVID, has withstood the COVID situation very well and supported the economy rather than been a negative in terms of the economic recovery. So I think that we actually see in the US experience and in other jurisdictions as well as the benefits of having a very strong, well-capitalized a financial system, so that monetary policy then has some more scope to really focus on the monetary policy objectives.
John, thank you. This has been absolutely insightful. I think we posed some questions all over the spectrum, and you answered them all. This has been, from my perspective, great. I want to thank you on behalf of the conference, and really thank you for your thoughts about a subject that all of us are thinking hard about and sort of grappling what's the right thing to do. This clarity of thought, as often in economics, is a super important issue. And I personally want to thank you for bearing with us this hour, giving the lecture and the questions. So thank you again.
Well, thank you for the opportunity to speak to the group. Thanks. Have a great day.
Thank you.